It's time now for today's strategy session. Has the market found its bottom? That's the big question. After a week of swift and steep declines, stocks are looking steady right now. So what is next for the S&P 500 after nearly entering a technical correction? It was down 9% from its peak. 10% is that level that we would be watching for the correction. Joining us now, we've got Ryan Detrick, good friend of the show, and Carson Group Chief Market Strategist, his more formal title. Great to see you here this morning. So, as we're thinking about that very question, have we seen the worst behind us from what the technicals are telling us?
Yeah, Brad, thanks for having me back. And Jared just gave a nice shout out to some of our work there. I mean, just from a purely seasonal point of view, you tend to bottom in March. I mean, I came into the year, and I know I came on your network talking about this, early in a post-election year, stocks don't do well. Early after a 20% gain the year before, stocks don't do that well. The last 20 years, the first quarter has been kind of weak. Now, the big question is the worst over? Listen, we're close, right? We're close. I mean, a lot of ways I could take it. I'll go this route. So we've had about a 9% correction. Maybe we go into an official 10% correction. But what's really neat about this, I like to say follow the credit markets, right? The credit markets are the smartest people in the room. Keep this simple for listeners. Look at spreads on triple B spreads and corporate spreads. There's not as much stress right now, Brad, as there was in early August when we had that 8%, couple day pullback on the very scary yen carry trade unwind. So we're not minimizing the red that's out there. Like you mentioned, the Mag 7, obviously a lot of people, unfortunately, have gone overweight the Mag 7, so this feels a lot worse. If you have a diversified portfolio, bonds up a couple percent, Europe up 10%, gold, like you just said, up 10%. Yes, the S&P is down, but there's some sectors that are actually hanging in there. So after, a 70% rally, the last couple of years, maybe this was just necessary. And we get the headlines, we get into that. But we were saying expect maybe a choppy first quarter. And boy, oh boy, it's March Madness. It's here.
It's certainly been choppy. One thing that I'm looking at, Ryan, is the AAII survey of investor sentiment. As you know, it's now at 59.2% bearish. Bears have been above 55% for 3 weeks. That's only happened one other time, and it was 2009. Ryan, is the bearishness just building to a point where even if the technicals are telling us there could be something positive ahead, the bearishness is just too intense to ignore?
Well, great question there, Maddie. I mean, listen, when you look at sentiment, right? There's an old saying, if everyone's thinking alike, someone isn't thinking. General Patton, I like to use that. If everyone's bearish, the sellers are already exhausted themselves. Now, I'll be clear. I think this AAII, I cite it. Everybody cites it. It's a lot of people that got heavy in Mag 7, okay? And that's why they're feeling the way they are. But reality is I get to work with financial advisors every day. I get to talk to their clients every day. I mean, I get those little internal messages to myself. There is a lot of fear. And we know it's political. We know it's because we just virtually had a 10% correction pretty darn quickly. Mag 7's lower. But the negative sentiment is a positive, right? I mean, I say it like this. Markets can go up on good news. We know that. They actually can go up on bad news. 5 years ago right now, we made a bottom. We went up on bad news. What they don't like is uncertainty, right? 47 times the word uncertainty was in the Fed's beige book last week. That NFIB small business survey, record number of the word uncertainty. So we do need some certainty on the trade front, but that doesn't mean the market has to stop going down. I mean, our market can stop going down. It can maybe consolidate a little bit. And again, the credit markets aren't showing major stress. That to me is the sign that this is not going to spiral out of control. One more quick one here. I just did this before we came on. Back to World War II, I found 48 times the S&P 500 moved into a correction. Now that's on a closing basis, so that's down 10%. We haven't done it this time, but really close. How often does it go to a bear market? Only 13 times. That's 25% of the time you go into a correction. Do you go into a full-fledged bear market? So our take is maybe we go into a correction, but we do not see a bear market coming. And again, early in a post-election year, choppiness is normal, and that's kind of what's happening.
Will the relief that the markets are looking for be the absence, perhaps, in the next earnings period where fewer companies are not only kind of adjusting their full-year outlooks, but also using the word tariff a lot less?
Yeah. Let's hope so. I guess hope's not a strategy, but listen, I mean, we know the tariff concerns are there. I mean, profit, one thing to remember, right? We're hitting record earnings. You mentioned earnings, Brad. I mean, everyone knows that. Earnings in the fourth quarter up 17% year over year, was expected to be about 11 or 12. Listen, that's what we've done for me lately. What are you doing for me next? We do have new cycle highs in profit margins. Now, with all the tariff stuff going on, we're going to, I mean, listen, if all the tariffs that are being floated out there, what's the latest? 200% on alcohol coming from Europe. That one just hit. I know it can change in a hurry. you're going to see some hits to earnings. I mean, the market is repricing risk. That's what we're going through right now. That's why we pulled back 10% and more in other areas, because you're repricing risk, repricing potentially growth. We came into this year saying 3% GDP growth. Listen, we don't think that's going to happen now with some of the uncertainty that's out there. We still like, low 2% GDP growth. That's not great. That's not terrible. We averaged 2.5% GDP growth for like 2 decades. So we're just repricing some growth here. But then the other thing, we haven't even talked about inflation. I know the reaction in yields, and you guys talked about it before it came on. I think a lot of the reason U.S. yields are higher is because of what Germany just did last week. Germany brought out the bazooka. Their 10-year yield had like a 4 or 5 sigma event, which is not supposed to happen in our lifetime in terms of the higher yield. So maybe global yields are perking up, but in inflation front, there's still some good positive things. In our base case, the Fed's probably going to cut 3-4 times this year without a recession. That's going to unlock housing and unlock some confidence in small business. Trust me, it's worrisome out there. There's some concerns, but there's still more reasons than not to be optimistic in our view.
Ryan, you've been talking about those investors who went overweight the Mag 7, who are now feeling the pain of those decisions and that investment strategy. What are the technicals telling you about what's next for that basket of stocks?
Well, listen, great question there. Extremely oversold. I mean, that's striking the obvious thing. But I'll tell you like this. I mean, I can't really talk individual equity names, but you guys listed a bunch of them, and some of them are cut in half, right? If you liked some of these companies a month ago on February 19th, when the market was making new highs, you should really like them now. And the market psychology, I work with investors all the time. If you like something up here, you don't tend to like it down here, right? Rebalancing, buying when things are cheap. What's the other saying? Stock market's the only place things go on sale, but everybody runs out of their store screaming. I mean, I think there's some really good valuations right now in technology and communication services, groups that we weren't too crazy about. Well, we were more neutral technology. We're okay communication services, but now there's some really good values out there. So if someone wants to kind of, I hate to say catch a falling knife, because that's what it feels like, but you can take some profits if you weren't in those names and get in them now. But if you've been in them, I think that's just a reminder to investors why you should stay diversified, why you should rebalance, and don't always chase the shiny object, because it can burn you sometimes. And we've seen that, unfortunately, with a lot of people who made a lot of money on Mag 7, but now it's not so good. And you look around and financials, other groups are hanging in there this year. But if you're tech heavy, it hasn't been a fun year.